Hello, everybody. This is Professor Hassey. It's our week number 5 introduction video to our class of Wednesday, March 2nd, and the week ending March 8th. You have your midterm examination, which was due last evening, March 1st, and I'll be grading that in the next couple of days. There's no graded work for this week, week number 5, no graded work. We're going to be talking about capital budgeting in our class on Wednesday evening, going over investment return and discounted cash flow, two very important topics that you'll need for your assignment number 3, which will be next week, and the week following your Road King Trucks case, course assessment case, which is due March 22nd, and now we'll review that and introduce that in class Wednesday night. But first off, in our introduction video, let's take a look at our definition of capital budgeting for this week.
Capital budgeting is the process of making investment decision in capital expenditure. Further, it involves the planning and control of capital expenditure. In simple words, if anyone asks you what is capital budgeting, then you can say it is the process of deciding whether to accept or reject project on the basis of benefits it will provide to the company in future. You should also remember the capital budgeting decision is in the long-term assets in anticipation of the expected flow of benefits in the coming future. The firm investment decisions would generally include expansion, acquisition, modernization, and replacement of the long-term assets. So for this, it involves mainly 3 things. It involves the exchange of current funds for future benefits. Secondly, the funds are invested in long-term assets. And thirdly, the future benefits are going to occur to the firm over a series of years. So in order to take this capital budgeting decision, we have an evaluation criteria, which we call as capital budgeting techniques. We have 2 different criteria for evaluating any investment decision. Firstly, we have discounted cash flow criteria, and the other is non-discounted cash flow criteria. In discounted cash flow criteria, we have net present value, internal rate of return, and profitability index. Whereas in non-discounted cash flow techniques, we normally have 2, that is, one, payback period, and the other is accounting rate of return.
%90 of golfers slice.
Okay, kind of a brief but basic introduction to capital budgeting. In the next 2 weeks, we'll be talking about this process of capital budgeting from chapters 8 through chapters 12 of our textbook. Quite a lot of material. We'll concentrate on 2 problem sets this week in class on page 263 and page 296 and 297. Those are excellent problems to explain this capital budgeting, investment return, and discounted cash flow process. Remember, as the video said, the bottom line is an investment in a long-term asset profitable? This is the process by which we do that, a very important part of corporate finance. We'll review this in class this evening, plus our course assessment case, Road King Trucks. There's no graded work this coming week. We'll see you all Wednesday evening. Adios.